Hello, happy Manufacturing Day, and welcome to the webinar. This is a Washington, D.C. update on federal government policy. This webinar is produced by One Voice for Manufacturing, that's the National Tooling and Machining Association and the Precision Metal Forming Association. And this webinar is put together by the Franklin Partnership and the Policy Resolution Group at Bracewell. If you haven't joined a webinar before or you're listening for the first time, you'll know that the Franklin Partnership is the on-the-ground government relations team in Washington, D.C., doing lobbying and public policy work. And the Policy Resolution Group at Bracewell is the strategic communications team for One Voice, and we are supporting government relations efforts with public advocacy and media relations. I'm Caitlin Sickles. I'm a senior principal in the Policy Resolution Group, and on today's webinar, you also have the team from Franklin Partnership, Omar Nashashibi and John. If you're a regular listener of the webinars, you'll know that we are missing Paul Nathanson today, who is my colleague at Bracewell. He is traveling today and can't be on. There's much to cover today. Anybody, unless you are living under a rock, you know that it's a wild world in the United States Congress the last few days, so there's a lot to cover there. Then we'll also talk about some of the latest on regulations. We'll give you an update there, and then we'll cover a few topics on trade, tariffs, and supply chain. Before we get to that, let me just show you one quick thing. I said at the top, it's Manufacturing Day. Manufacturing Day is the first Friday of October every year. It is a kickoff point for Manufacturing Month, which is the entire month of October. Many of the folks on the webinar today may already be participating in Manufacturing Day by opening your facilities to members of your community or elected officials. It's certainly a great thing to do to showcase what modern manufacturing looks like. Here's a few graphics that we are sharing this week on the One Voice social media accounts. If you would like to share about Manufacturing Day or Manufacturing Month, you can find that content at One Voice for Manufacturing on X, formerly Twitter, as well as on LinkedIn. You can look up the One Voice page and also PMA, where there's some One Voice or some Manufacturing Day content. So with that little plug for participation, I'm going to turn it over to John to tell us a little bit about the, I started to say activities, but maybe dysfunction happening in Congress. John, let me turn it to you.
What are you talking about, Caitlin? This is just perfectly normal times in Washington.
Yeah, everything's going fine. Everything's going fine. You're right.
As I'm sure all of you know, last Thursday, the House voted to dethrone Kevin McCarthy. So the speakership has now been vacated. Right now, you've got a congressman, the Majority Leader Scalise from Louisiana, Jim Jordan from Ohio, both running for speaker. Others may jump in. House Republicans are planning a open forum, a candidate forum next week, and they hope to vote on it next week. I'm not very optimistic that they will be able to get the 218 votes. Essentially, what happened was 8 conservative Republicans joined all the Democrats in not supporting Kevin McCarthy's appointment, remaining a speaker, and so that led to him this position being vacated. I mean, I don't think in the end, maybe it may not even be Scalise or Jordan. We may not know who the other candidate who potentially could become speaker. But in the meantime, everything is frozen in Congress. Last week, we told everybody that there was a 47-day continuing resolution to keep the government funded, and the goal was to pass appropriations bills. Well, after Speaker McCarthy got bagged, Patrick McHenry, who's the acting Speaker pro tem, basically shut down the House for an entire week. And so no appropriations bills were considered this past week. And so things are basically frozen. If somebody like a Scalise, who is the majority leader, gets elected speaker, then there'll be an election, for a majority leader and further down on the leadership bandwagon right there.
So what this makes, to John's point there, what this practical effect is, at least on the House side, that means now legislation obviously cannot move without somebody at the top. And now whether that takes, in the best case scenario, they get something done on Wednesday, which is highly unlikely, then they could potentially start resuming. But in the more likely case, it drifts into at least the following week. Where this now puts us is that 47-day extension to November 17th that John referenced is likely in danger, and it's highly unlikely at this point that Congress is going to be able to pass many, if any, and certainly not all of the 12 government spending bills that need to be done by November 17th to prevent a shutdown. I mean, we all expected another continuing resolution into December, but really what's going to go on next week, and who knows with President Trump showing up on Tuesday night, what impact that will have on further possible delaying House action. The Senate, meanwhile, can continue trying to box in the House, which seems like that's what they're going to keep trying to do on the federal spending and some other the bills there. They'll ultimately need bipartisan agreement regardless, but there's still a number of sticking points that are out there.
Two of the main sticking points is the Senate largely is looking for any final spending bill to include funding for the war in Ukraine, while House Republicans say they're not going to vote for a spending bill unless there's additional border funding. And so to Omar's point, this is going to have to be a bipartisan agreement. There's growing hesitancy with House Republicans to continue funding the conflict in Ukraine.
The war in Ukraine. So for those of you, if you could, on the border side, just got off a call a few minutes ago with regards to the Texas border and commercial goods going across the border. The state of Texas has effectively shut the borders down by implementing 100% commercial truck checks at this point. Many of these OEMs and high-level tier ones were just telling us on our call that they are looking at 10 to 12-hour waits to get from Mexico into the U.S. and then roughly 2 to 3 hour waits for the trucks to go back into Mexico with parts and supplies to those facilities there. Offline, if you're comfortable sharing, there's a call this afternoon that some of our colleagues will be on with the White House, and then it'll continue conversations into next week. Right now, Customs and Border Protection doesn't know how much longer that this will last down at the southern border with regards to Texas side of it. But the White House is certainly engaged from a supply chain disruption standpoint and watching it very closely. And this was beyond automotive. We have a number of appliance and other groups that were on this call that were raising that. So if you feel comfortable sharing anything, if you're seeing any disruptions, please reach out directly and we can connect some of that information with the people that are into it. But John, just a couple quick clarifications here on the overtime rule that we had when we gave our last presentation. We were working on what was potentially going to be an interim final rule that they were looking to publish. We had the pre-notification. The draft rule did actually come out during our call. So now that we have more clarification, we do see that the rule will take effect 60 days after a final rule will be published. A final rule can be published anytime after early November, which likely means that a final rule for the overtime could take effect as early as early January.
And what they do in the proposed rule is they increase executive, administrative, professional, and clerical fees from $35,568 to $55,068. They increase the threshold for highly compensated employees from 107,432 to 143,988. Now, what that means is we are suggesting to NCMA and PMA members to look at your payroll, look at your staff, how many people are going to be impacted by this, because as Omar said, this will take effect relatively quickly, 60 days after final rules published, likely in January.
And keep that in mind that the proposed rule does say it could go up as high as 60,209. And so that is a real possibility there as well. And that would also increase, as we've seen in the past, what Wage and Hour Division of the Department of Labor, that's who puts this out, WHD, they did to help with the transition, put out an FAQ that's broken down into a number of sections. Why am I doing this rule? Who is covered? So for those of you that are unsure about who would fit under the EAP and some of this, the section 2, if you click that link for the FAQ, that will give you more information on it. But to put it more into perspective, since again, those are just proposals, here's part of the FAQ that they put out just in the last few days on what some of the estimated costs that they're looking at on employers and employees: $240 million in adjustment costs, $539 million in managerial costs, and many of those $1.2 billion income transfer in just year one from employers to employees. So this is certainly, that's going to be quite significant in some of the other stats that you've seen from us in the past on there, and making, again, nearly 250,000 more workers additional eligible that are on the highly compensated, whereas many have been focusing on just those that are traditionally going to be under that 55 or 60,000 threshold. John, also though, a couple other things sticking with the Department of Labor, EEOC, and a couple of MOUs signed, but this is one example of them.
Yeah, this is just an example of where two agencies, Department of Labor and Equal Employment Opportunity Commission, coming together to enhance enforcement of the rules at the Department of Labor and the EEOC. They want to be more responsive to their customers, and they're going to provide some cross training for the EEOC and Department of Labor employees. So they're trying to make DOL and EEOC run more efficiently.
Yeah, and we've seen this Department of Labor looking at OSHA and also NLRB and a few other areas where the EEOC is signing MOUs across agencies to improve their enforcement there as well. And staying with that agency as well, the Equal Employment Opportunity Commission did put out a proposed guidance explaining some of the employer liability with regards to harassment claims under federal unemployment discrimination laws. EEOC, obviously, those are based on race, color, religion, sex, including orientation, status, pregnancy, origin, age discrimination over 40, genetic information. And within that guidance, there's a number of updates, and one of them to take note of is addressing the proliferation of digital technology and how social media postings and other online content can contribute to a hostile work environment. Again, next time you're updating your employee manual, this is probably an area you want to be revisiting, possibly with your counsel, especially in light of any access to company-owned electronic equipment that could be used by an employee that could ultimately trigger a harassment complaint that is out there. We are seeing some movement though, John, coming out of OIRA. Just to put it in perspective, over at the White House, there's an office within the Office of Management and Budget called the Office of Information Regulatory Affairs. Virtually every regulation that's significant enough out of most agencies has to go through OIRA for approval. Most of them get cleared in 60 days. Some will languish for a few years. So when we see something go over to OIRA, that means it's cleared the White House's approval, and it's pretty soon to coming out and being pushed out by that agency.
We've seen this rule. This goes back to the Obama administration. This rule has bounced back and forth between President Obama, President Trump, and several judicial rulings, which made proposals change the intent of this. And so, as Omar says, as this went to OIRA, we do expect independent contractor rule to be forthcoming any day now. Similarly, on the joint employer, we expect the NLRB to issue something imminently. But since it goes over to OIRA, this proposal has essentially been cleared.
Also on OSHA, switching over to OSHA, a couple of things. Expanding whistleblower outreach. The Department of Labor has an open notice. Public comments are due on November 7th. What they are looking at ways, and they've got a public meeting that's coming up here in a few weeks. And what they're trying to do on October 24th is going to be the open online meeting for individuals. They're trying to improve outreach and training initiatives for both supervisors, employers, and also for employees. If you want to look at a whole of government approach over at the Department of Labor, this obviously would increase not just whistleblower activities in general, but with a focus on indoor heat, noise, a number of other national emphasis program priorities that OSHA has out there. So that's something for employers to keep in mind, especially when we are trying to see an increase, we're already seeing an increase in enforcement. This is an additional avenue that OSHA is pushing forward out there, but we are getting at least some kind of a reprieve, John. I think we were hoping for 60 days on worker walk around.
Yeah, this is an issue we've talked about in the past. This is when a worker in a shop can ask the OSHA inspector to have a third party non-employee to walk around, and the OSHA inspector can accept that if he believes having a third party person, is reasonable and necessary. And so we expected this rule. This rule is moving forward and taking effect. As Omar said, we were hoping for a 60-day delay. It looks like it's going to be a 14-day delay with comments due on October 30th.
Yeah, so they'll delay that into November, just ahead of Thanksgiving for the comment period, which still puts it online for some time this winter. As most of you know, EPA and OSHA, they're divided up into different regions, and that's how they do different rules. OSHA has a national emphasis program. That's where there's the heat rule, there's machinery, there's all kinds of things. Silica are all under the national emphasis program. They also have what's called regional emphasis local programs. And an REP here is an example of one for Region 4 that covers Alabama, Florida, Georgia, Kentucky, Mississippi, North Carolina, South Carolina, and Tennessee, where they focus in this case on noise emphasis, particularly in looking at the NAICS codes that are covered, including fabricated metal products, motor vehicle parts manufacturing, and a number of others that are out there as well, and gives you examples of some of your NAICS codes and updates some of the emphasis. Now, what these are, they're not directives to companies. These are directives to OSHA inspectors and enforcement individuals. So what this is where the region is telling those that are under their area of jurisdiction, those are what they're supposed to start looking for those inspectors. As you can see, they added some things to the technical manual reference, inspection procedures, and a few other areas that are out there. And they're certainly continuing that noise regional emphasis program, which means they're going to want to hear from you upon inspection, some of your mitigation and some of your other techniques that you're taking there as well. I can touch on this one quickly on PFAS. On forever chemicals, we've increasingly been hearing from some of you all in light of what's going on. Former President Trump signed into law a few years ago a requirement that the Toxic Substance Control Act continue to cover and expand to cover PFAS. And those, again, you'll think of it from in the headlines of 3M, but there's a lot of it that goes into metals, plastics, and a number of other products that are out there. And now there's additional requirements, reporting requirements that are coming out from the EPA as well. The EU is on track to ban these forever chemicals starting in a couple of years, as early as 2025 and then 6 and 7. And Canada just released a report treating them all as a singular definition, which is problematic for many as well. But flagging this in case you're starting to hear more about it from your customers, as we are certainly starting to see more about it from regulators. But speaking of which, trichloroethylene is another one as well, John, we've been working on for a number of years.
This is one, once again, where it goes to OIRA, Office of Regulatory Affairs, and it looks like the White House is finalizing the trichloroethylene, an issue that not all of our NTMA and PMA members utilize use TCEs, but those that do need to be aware that this final rule is coming out.
Lastly, in this section, before we jump into some tax issues, we're going to try to keep us on time for a stop at 12:30 here. A couple of things just came out here. This is the round 2 of grants for those that are returning from jail or prisons. Couldn't fit it all on one line. The Department of Labor just issued a second batch of awards. This is a total of, I think, $68 million or so has been put out. This is the second one that just came in. California, some of the other bigger states, those were in the first batch. As you can see, individual state allocations here. Colorado's getting 4.2 million. Tennessee's getting 4.4. A number of others are getting some money. Texas getting 4.6. So again, this is intended to help with training and supportive reentry services for individuals before their release into a center, and then training and job placement services will be the second part of the transitionary period, and then working on additional employment services and on-the-job training, getting the OGT going, and then fully release into the community as part of the transition. Again, for those that have had success in this space, hopefully you're possibly in one of those other areas, and then keep in mind what some of those other developments might bring in. Let's just go jump. We have a whole section on the IRS today, John.
Yes. So, we've heard from the past year that the IRS was hoping to hire 3,700 new employees. Well, the IRS is looking at expanding the study of high income, high wealth pass-through entities. Here we're talking about people with over $1 million in income or wealth, $10 million in assets. It is their intent to essentially, as we often say, when things start in California, it generally impacts around the country. When something like the IRS starts looking at high income, high wealth earners, pass-through entities, this is just the beginning of the study of pass-throughs.
Yeah, so there's a few things there. Obviously, they're looking at those with having a tax debt. So there's a few layers. It's not that they're going after everybody, obviously, but there are going to be some categories where, due to the reporting structure of the entity and the business, there could be some debt that's carried over and or reported. And so it could trigger additional enforcement. And that's how you're seeing that additional hiring that's out there. And part of this is the IRS, as they said, they were pledged to increase the number of enforcement folks and a number of provisions that are out there. As before, the Republicans had a chance to repeal some of those funds. I think it was the $81 billion or so towards that on enforcement. However, in some of these comments that have gone along, As you see, the month of September, we've gone September 8th, now September 15th. And then here you go on the next one on September 20th, where you're seeing again IRS establishing special pass-through organization to focus on these compliance efforts. They still are saying that they are not going after those that are below 400,000. They've continued to say that in their pledge, but keep that in mind that we'll see where it should go from as well. What we could also expect to see is beyond that additional enforcement, you are starting to see some additional guidance, some changes from the IRS as well on their research and development tax credit. So this is the credit, this is the IRC 41 section of the Internal Revenue Code. This is the traditional R&D credit. They are making some additional changes to this form. So make sure that working with your tax preparer, that you're aware that you're not just using your previous year's calculations. There are a couple of them that are semi-minor, some are not probably really relevant to a few of you, but for others, there really could be some changes here. You may want to take a look at that, but let's go straight to the headlines, John, because this one has gotten a lot of attention.
Many of you probably have heard the television ads from third-party entities who are saying that they can help you get your employee retention credit refund move forward. And so here, the government basically is a warning to employers that there's been a tremendous amount of fraud and abuse, and to proceed carefully if you are using these third-party entities to retrieve your employee retention credit. And then the second one is the announcement that they are going to stop issuing the ERCs until they can further get a handle on the fraud and abuse that's taking place within the employee retention credit system.
Right. This is something we obviously have been watching closely. One Voice submitted a letter to Congress over the summer saying we need to move forward on some of the backlog that continue to exist there, and that processing the new ERC claims is going to continue, as John mentioned, into next year as they're trying to work through that. Wall Street Journal, I think on A2 today in the paper, had another article about the difficulty they're going to have the IRS in looking back on some of these, and if they do lose and try one of these cases, as some of the attorneys were saying, then it could set a precedent, then other companies can continue to get away with it. So obviously bad actors as usual, causing some challenges and some problems here on the ERC front that we're continuing to watch closely there. Another set of guidance that came out from here, I don't know, John, if you want me to handle this one, but on the corporate AMT, the alternative minimum tax, as many of you are aware, that there's a corporate alternative minimum tax that was created under the climate law that the Democrats passed a couple of years ago, the 15% minimum tax on certain large corporations that dealing with exceeding $1 billion. Well, this is starting to comply with some of the GILTI, G-I-L-T-I language that is required under the OECD agreement the US and 41 other countries have pledged to do on a global minimum tax. And the guidance that the IRS just put out didn't entirely have a lot of flexibility in what they did, particularly with some of the AFS statements that people were putting through, the applicable financial statements. The IRS is trying to put in a certain set of requirements and not allowing the certain priority of your AFS. And there's some groups out here, and the reason that this impacts some of you all is it'll impact some of your customers as well. Is the hope is to allow taxpayers to be able to use separate AFS that is equal or is in higher priority, that would be a little bit more consistent with the order that they are looking at, and that way taxpayers wouldn't be as subject to that before the threat below that threshold of 100 million. So for some companies, you may want to start thinking about where they are on the new corporate AMT, since that is going to hit some folks out there. I know this one, some companies that at least I'm working with have been watching very, very closely, but John, you're welcome to jump in here on the smaller scale semiconductors.
As Congress passed the CHIPS Act, recent grant announcements that came out were towards those larger semiconductor chip makers. Well, now we're starting to see the money trickle down to the smaller semiconductor producers. And so here's a program, $500 million, for small semiconductor chip producers. And so this is just where the money's trickling down, and those who are engaged in semiconductor, who are not those large, massive companies like Intel, could take advantage of this additional money.
So we've already been in touch with some companies. I mean, there's going to be probably some One Voice type member companies that do have some opportunities to either not work on this directly or at least indirectly with some of their customers. So that's something to know that it's gotten more accessible now that they've gotten below 300M. We've been watching this and talking to Commerce Department, but it's going to move very, very quickly since there was greater interest in the below 300M as people were waiting for that, at least the folks we were talking to, as a more manageable size product that's out there. But we do want to note that we do have a couple of deadlines coming up here. President Biden has invited and they have accepted from the European Commission and European Council. We'll be coming to town here in a couple of weeks on October 20th for a EU-US summit where they're going to discuss a number of issues, most importantly to us. It's going to be focused on the EU. They're going to likely talk about some kind of a carbon tariff agreement. Obviously, it doesn't look like that they're going to reach a deal by the October 31st deadline where the US and European Union were going to create some kind of a club where the carbon pricing would have been applied to steel and aluminum going across their borders. And if it exceeded a certain amount, a tariff would be imposed. If a tariff or steel or aluminum that exceeded that carbon footprint from another country, not in the club, came in, it would have a higher tariff is what the US wanted. They weren't able to come to that agreement. The backup plan the US wanted was going to be some kind of a tariff on excess steel, and they were in the process of determining what that is. So we suspect in the days that week leading up, so week after next, we're expecting some kind of a leak or announcement from folks we know at USTR to tell us what they were thinking this week. Yeah, a few days, the last couple of weeks, days rather, they've been trying to figure out what are those levels that they want for that global arrangement of sustainable steel to include those numbers with regards to the permitted amount of excess from non-market economies that they're going to allow in before they apply a tariff on steel from China and elsewhere into the US. So watch on that potential deal to be announced, interim tariff to be announced on October 20th. That could take effect as early as January 1 with promises to move forward on a carbon tariff, which is what the CBAM is, John.
Carbon border adjustment mechanism that the EU is putting forth. It's going to be phased in between 2026 and 2034, but we're already seeing manufacturers starting to receive letters from their customers wanting to determine what is the greenhouse gas emissions, direct and indirect, with the products that they are using. And so this is a reporting mechanism to determine greenhouse gas emissions for not just the production of steel, but the components that go into steel.
Okay, yeah, so what this one is, for clarification, what the Europeans set up to replace their emissions trading system is what they call the CBAM, the Carbon Border Adjustment Mechanism. At this point, it's only focused on a group of select industries. They were going to go broader into chemical. In the end, they narrowed it down into just fertilizers and hydrogen. They're going to expand it out into products later on, but this one does not look at the scopes 2 and scope 3. It only looks at the direct emissions related to the product that's manufactured on its own. And from that standpoint, what is required starting on October 1st, a couple of days ago, is that those producers of those products that are going to be exporting into the European Union are going to be forced to start putting together a report that is going to start being due on January 1st of 2024. That report for the third quarter of 2023, it's going to have to put out, including all the different footprint that's assigned to you on your CO2 for your carbon. Between now and the end of the calendar year, the European Commission is going to put out the rest of their guidance. It's going to be a fact sheet guidance that they're going to put out for the different sectors that are there. But when they come into it, they're really only at this point, they're not going down into the supply chain. They're only focusing on those direct reporting from that footprint before they go out there on what you're bringing in. By 2030, they are talking about expanding to beyond other goods as well, beyond those initial of cement, iron and steel, aluminum, fertilizer, electricity, hydrogen. If you do go into the actual Annex 1 right now, the European Commission document, you can see in there where they do have a number of HTS codes that start with the number 72 and 73. So when we go through, there are a few members, especially on the machine shop side, you could be captured under this if you are exporting into Europe, but most on the stampings, you're starting in chapters 84 and 87, so you're not really affected. It's really going to be 72 and 73 for iron and steel products that often case are forged, cast, and in some cases somewhat other changed. But your customers obviously are going to be seeing this, and then they are likely going to be expanding it in 2030 when they do go further. And what right now we're just in a reporting mechanism. Ultimately, the European Union is going to be switched to a tariff model, and that's why the discussions on October 20th are so important, is because the tariffs that the European Union and the United States are discussing on steel and aluminum ultimately could be a model for other industries and be applied more broadly. And yes, of course, they would be applied as well to China and others as well if the US and EU came to an agreement. What the CBAM system is that they already launched on October 1st, it does apply to everybody starting October 1st, including China, and it will also apply to the United States as well, since we do not have a measurement system ourselves. And that's what the US is trying to do, is come up with something here that they can be able to compare and get credit, so that way US goods aren't going to be subject to a tax, which is a tariff that ultimately will go into effect starting in 2026. They're going to call them CBAM certificates that you're going to either have to buy or hand over, and then you can obviously trade them similar to what the ETS is. So that was one of the developments that just came in on October 1st. We wanted to give you a heads up as that program, in case some of you are exporting directly, and as they start ramping up, you'll hear some more of that. But speaking of ramping up, Caitlin, we obviously have been hearing quite a bit in the news this afternoon at 2 o'clock Eastern, so in about an hour and a half, we should be getting another update from the UAW of what's there, but we know you've been very active, you and your team, on this.
Yeah, no kidding. This is obviously an issue that impacts a lot of members, particularly people who are suppliers to the automotive industry. We've had a lot of media requests, and thank you to those people who have been willing to participate in interviews both on the national and local markets. Here are 2 recent examples of interviews that we've helped to facilitate. Inquiries on this and other issues keep coming in, so please do let us know if you are willing to speak to the media about this or any of the other issues really that we've discussed on the call. Of course, all issues impact members differently, and we're cognizant of that, so we are always happy to have perspectives, and let us know, who's willing to participate in interviews and make their voices heard. As we all know, reporters like members of Congress are eager to hear from people on the ground. Policy experts are great, but people who are on the ground, that's a really helpful voice. So thank you to those who are participating in a call for others. You can hear more from us on our podcast. We were just talking before the webinar started about what we'll be talking about coming up. Podcast is a lot of policy, but it's a little politics too. So on the podcast, you can hear, what our predictions are on the speaker race and that kind of thing. If you tuned into the episode last time, you would have heard us all predict a government shutdown. So we're not right every time. But to be fair, most of the talking heads were predicting that. You can find the podcast Talking with One Voice wherever you find your podcast. I hope you're subscribed or you'll tell others about the show.
Thank you so much, Caitlin. As always, you can continue to be supportive of us if you haven't in the past. First timers are always welcome. That's how we are able to bring these podcasts and these webinars to you and continue our lobbying efforts on your behalf. We did not cover R&D and many of those other issues. It's going to be a rough fall and winter, and obviously any support you can provide is welcome. As always, please write in any questions you have in the right-hand side on the box that's there. We'll hang on here for another 30 seconds or so. As always, you can feel free to reach out to us individually, particularly any questions that you've got on the southern border and the Texas border, rather, on commercial supply chains. Also, thank you for those of you that filled out the survey that you received. If you're in the automotive supply chain on electric vehicles, that's something that was requested by a contact of NTMAs and of PMAs over at the White House, and we wanted to be responsive to them as well. So thank you for your support there. One question that we did just see, and I'd rather not entirely put a number on it, but we'll go ahead and give it a shot. Best guess at the odds R&D will revert back to pre-2022 rules. That's a reminder that under the TCJA of 17, you no longer can fully expense your R&D activities as of January 1 of 2022. What we're still waiting on right now is a vehicle. We do believe that there's still a pretty good chance on stage. I think John and I were together at this conference. I did say that I do believe we're at a 60, 70% chance of getting R&D fix done, but it really comes down to whether or not there's an overall deal on child tax credit and some other unrelated issues. So we're just looking for a vehicle. Right now, no one's in the House. They're shut down. Republicans can't talk about it, but we are still feeling pretty confident that when some of this is settled, that we will get to see some movement, but it likely will not be until after Thanksgiving. We are likely now going to lose the month of October negotiations on taxes that we were hoping was going to kick things off. So your timeline is still likely going to be tied to any government spending bill, which we are still looking towards probably completion right before Christmas. But we will keep you posted on that. Thank you to everybody that's been supportive. We will probably see an action alert from that on us once the dust settles over in the House, then you'll hear more from that on the podcast next week. Thank you, everybody. Appreciate your time today. Enjoy your weekend, and we will talk to you next time.